actually have that same long-term view. I'm a big long-term bull. I'm just a shorter-term macro economist looking at the cycles and everything like that. So the beauty of 12 to 13,000, it gets us to that 80 to 85% correction that Bitcoin has done every single cycle. So that kind of gives us a basis of what to look for. It's also a strong technical support. But you're right. I mean, if you're a long-term investor and you're not going to look at it for 10 years or 5 years, there's nothing wrong with that. You just have to, this is the key, right? You have to be able to weather the emotional storm, because I know a lot of investors out there, they might buy in at 22 or 21, and when they're down 40% at 12, they might panic and unload, because you're going to hear a lot of negativity out there. And if you have to be able to control that and shut it out, and then you're okay to do that. But if you're someone who's very emotional and you're going to exit the trade at that point, and then it goes to 50,000, then 100,000, that's not a good scenario for you to be in. So if you have emotional control, that's fine. Start inching in. I also advocate for dollar cost averaging. Buy a little here at 21, buy a little bit more at 18, buy some more at 15, and so forth, versus just going all in at one specific level. So what we saw is Friday, when the equity market sold off, you got this nasty candle. It did close below this channel. So look at the beauty of this channel here, how we've been hovering up and down inside of it really since June. But the negative here is that we saw a close below. Now, you haven't confirmed, but as far as I'm concerned, this is a very, very nasty little pattern formation, and it's likely we're going to go retest this yellow trend line here, which happens to be the high from 2017 right here. That's going to be a big line in the sand. If we break that, then you see that move down that I've been calling for as my secondary target. You know, my first target was 20,000. We talked about it last year in Dubai when I was there in October 2021. We said 20,000. Now I say it's going to actually go lower than that. Next stop is going to be 12 to 13,000. So we are headed lower, and it's going to be a rough road along the way. I don't think so. Not at this stage of Bitcoin's life cycle. I think down the line you will see a kind of a difference, and Bitcoin and the crypto market start to emerge. But right now it is tied to a risk asset. I know a lot of people said in 2021, oh, it has nothing to do with the stock market. It'll go up when inflation goes up and the markets sell off. We obviously learned that that wasn't the case. So I'm in the camp that we're going to see crypto sell off with the stock market. I have a big downside move coming later this year in the stock market, and that's going to be the catalyst to really take us to that 12, 13,000 marker on Bitcoin. And I actually think that Ethereum is very likely going to head down to this next target around $645. So I have it priced in. That should be the level that Ethereum hits when Bitcoin hits 12 to 13,000. So I mean, it's a nasty collapse. And I think the biggest thing to understand here is that this is all about human psychology, right? So in 2021, we saw stocks like GameStop, AMC, Bed Bath Beyond soar to ridiculous heights and then come back in. And what we've seen here is that it's the Wall Street Bets crowd has tried to relive the magic of 2021. So they've started to pump these things. They started to run. We saw them go up precipitously, but not as high as 2021. And they've come crashing in so fast. This is the psychological part of it, is that you have, number one, the same investors that were in last time, they got burned when the collapse occurred. So they're much quicker to pull the trigger. Last year, you had months of people saying, hey, I'm never going to sell. I'm going to hold on. You had the apes. You had just all of these things going on, right? And ultimately, that is no longer intact because human psychology remembers the collapse and people are selling into it. The last thing to remember is that this was inevitable because the Fed in 2021 was printing money. The government was sending checks. All these things, the Fed was basically leaving interest rates at zero or near the zero marker, and that helped these stocks run. Now you have a totally different scenario. You're in a bear market, and that means that these stocks did not have the same flight that they would have last year. So not surprising to see the collapse. I hope not too many people got burned on this, but nonetheless, it is scary, the falls that these things have had. Saying follow the herd. You never want to be a follower of the herd. Occasionally it works. It gives you a false sense of security. Generally, when you're following people, you're going to end up losing, especially when it's the herd mentality. The smart money gets in at the beginning of the run, the dumb money later on, and you never want to be in that crowd that's chasing at the end. So avoid the hype, essentially.
At the start of this week, crypto investor sentiment worsened after weaker conditions in Chinese real estate markets forced the central bank to reduce its 5-year loan prime rate on August 21st. Moreover, a Goldman Sachs investment bank strategist stated that inflationary pressure would force the U.S. Federal Reserve to further tighten the economy, which negatively impacts the S&P 500.
What was going on over the summer is number one, the markets had started to bottom, and we started to have this kind of turnaround in the equity markets where it was becoming a risk on environment. And what you notice is the meme stocks ran just at the end as the S&P was topping out here. And if we go to the S&P chart, it's getting crushed today again, just like it did on Friday. But look at the chart here. I mean, this is the beauty of the charts, David. And I know you know I'm a technical chartist, but look at the level we ran into. We had this monster move up right to the 200 moving average, right to this downsloping trend line, and right to this gap fill. I call that a 3-factor resistance line. And that is a beautiful thing. It basically choreographed we were going to roll over, and you can see the meme stocks kind of ran into that. And then we've seen that fall as well. So again, the charts tell you a lot about what the probabilities are. And they were saying we were going to come down or start to fall in the market. And the answer is it's very likely, or I shouldn't say likely, but it's very possible that that does happen. I'm not in the case of that. I mean, you can see over here when we broke lower, we came back just shy of the 200 right there. So it is possible, just like Bitcoin. Like if we go to the Bitcoin chart, you can see here, we haven't even come close to the 200 on Bitcoin, which is kind of sad to think, right? I mean, it hasn't even come close at all, but you can see right here, it did hit the 200 before that next cycle to the downside. The problem here on the Bitcoin chart is that this was a very defined bearish pattern, and now you're below it. So that is problematic. Now, again, we have to hold this 19.6, 19.5 level, which is that key level from 2017. Otherwise, again, we should be heading very, very quickly. And again, just watch the stock market. I strongly encourage everyone to just keep an eye on the stock market. That is going to be your indicator. If this continues and we continue to see this fall on the S&P, I don't believe that the crypto markets can withstand that.
That's it for today, guys. If you found this video useful, then don't forget to like the video and share this knowledge with your friends and family. And don't forget to check out the full video. Link is in the description. Thank you.